All right, hello there, everyone. My name's Mark, and I am a former trader in the institutional world. I was a market maker. I oversaw the trading of probably about 10 or 15 different hedge funds. I worked for two of the greatest in the history of the industry, Gabelli and Steve Cohen. So it's not too much I haven't seen in trading. Uh, there's really not much I haven't seen over the last 25 years. And history just kind of repeats itself with Sam Bankman fraud and so forth. It's like the modern Enron. Anyway, I just want to take a quick look here at Tesla. And you could go to our website, stockmarketjobber.com. And that's a term that we used to refer to traders in Britain. But then in our country here in the United States, when the country was formed and the Hamiltonians or the Hamilton followers wanted the bank, the people that were against the bank, the Jefferson followers, said, these people are stock jobbers. So it became a derogatory term. But I think it's pretty cool. So anyway, I am the stock jobber, aka Professor Mark. So I just want to look at Tesla here. This isn't a trade idea. This is more of a little bit of a trading lesson, just so you can learn a little bit about how the financial markets work. So one of the main things about markets, or a main principle, is that some price levels have more importance than others. Sometimes we know why, sometimes we don't. It doesn't really matter if we know why or not. We just want to know where they are. Because when something gets to an important price level, it's like we get to an important fork in the road, or a crossroads. It's going to go one way or the other. It's generally not going to hang out at that level for too long. So this is a 3-year chart of Tesla, and we can see this 110 level here, right? Now, way back here in May of 20, and remember, this is a 3-month chart, so this is like a couple of weeks here. I'm sorry, it's a 3-year chart, so this is a couple of weeks here. So 110 was resistance, and then somehow it miraculously became support, and then it became support again. Now, the traditional reason for this is due to seller's remorse. Investors sold, and when the shares went higher, a lot of these sellers regretted doing so, and they told themselves, all right, well, I'm going to buy my shares back. I made a mistake, but I'm only going to buy them back if I can get them for the same price I sold them at. So they placed their buy orders at the price they sold at. And if there's enough of these buy orders, it forms support around the prior resistance level. So that's a conversion here. Another thing we talk about is sometimes these important price levels can stay intact for a long time. Now, here we are recently, and guess what? Once again, 110 has become support. This is what we call market memory. The market has remembered this important level. Support is a large concentration of buyers. When a market's trending lower like here, there's not enough demand or buyers to absorb all of the supply or sell orders. So the sellers have to put their shares out at a discount, and that forces a downtrend to form. When we get to support, the tide turns. All of a sudden, there's enough buyers that all the selling will be absorbed, and that's why the market stops going down. So anyway, it's just a little bit of a brief thing that institutional traders look at. There's a lot of mythology about what happens in the institutional trading world. Probably 95% of what you heard isn't true. But I will tell you this, that as a former trader, I know firsthand what the good traders focus on, and one of them is what price levels are important. So make sure you check out stockmarketjobber.com and join our community. There's going to be trade ideas, community. We talk about everything pretty much in the financial markets: bonds, options, ETFs, cryptos. And make sure you let us know if you want to have notifications. All right, thanks everyone. I will see you soon.